They made their move under the cover of darkness Friday night. Margin requirements surged. Order books flooded with selling pressure. Charts blood red heading into the weekend. For 48 hours, the narrative was clear the rally was finished. But when London opened this morning, everything changed. The metal roared back with a vengeance. What we're witnessing is one of the most significant market events of the decade. This wasn't some press release or Fed statement. This was pure price action speaking louder than words. The market didn't just recover, it absolutely exploded. A massive overnight gap erasing an entire sell-off in one session isn't typical behavior. This is institutional money screaming. This is a textbook trap slamming shut on some of the biggest players in the game. This is the market revealing there's no physical backing left for paper positions. And this confirms that strong conviction buying has evolved beyond retail enthusiasm. We're now seeing sovereign nations and industrial giants stepping in aggressively. If you panicked and sold during that drop, here's the reality: you provided the liquidity they desperately needed. You became the fuel for this rocket. But if you held your position and understood the mechanics at play, you're watching real-time vindication unfold. In this comprehensive market breakdown, we're not making predictions. We're examining the evidence. We're analyzing exactly how institutional players attempted to suppress this rally and why, for the first time in decades, their strategy completely failed. We'll explain the mechanics of this V-shaped recovery and why this specific pattern strongly suggests the low is established. The paper market attempted deception. The physical market just delivered truth. This is the anatomy of a failed suppression attempt. To understand the intensity of this rally, you need to understand the setup that preceded it. In financial markets, nothing moves in a straight line. Bull markets are specifically designed to shake out weak holders. They're engineered to inflict maximum psychological pain on the maximum number of participants. What we witnessed recently, that sharp, sudden drop that terrified everyone, was a textbook trap setup. Here's the exact mechanism. Institutional players know precisely where stop-loss orders cluster. They understand that thousands of traders set automatic sell orders just below key psychological levels like $60 or $62. To generate liquidity, these players must trigger those automated orders, so they utilize catalysts, a margin increase, or alarming headlines to push price down just enough to activate those triggers. Boom. The stops execute. Traders sell automatically. Price creates an intimidating downward candle. This convinces bears the trend is breaking. They pile in aggressively. They short the market heavily. They bet everything that silver's heading back toward 50. But then the trap closes. Because the institutional selling wasn't an exit, it was an accumulation strategy. They push price down to manufacture selling volume. Then they absorb absolutely everything. They purchase contracts from panicked traders. They buy from overconfident bears. And once they've filled their positions, they step back. Without that artificial pressure, natural demand takes over like a coiled spring releasing. Price rips higher. It gaps overnight. Suddenly everyone who sold at the bottom is holding cash they don't want. And everyone who shorted at the bottom is underwater. They're forced to panic, buy to cover losses. Their buying accelerates the rally even further. This is precisely what just occurred. The drop was manufactured. The recovery is authentic. The violence of this upward move tells you everything about the underlying strength. Weak markets bounce like dead weight. Strong markets bounce explosively. Silver just bounced like a super ball on concrete. We discussed previously the margin increase, exchanges raising capital requirements to force position liquidation. Historically, this has been the ultimate weapon. In 2011, it worked perfectly. They raised margins and silver collapsed 30% in days. It scared speculators away for an entire decade. They attempted the same playbook again. This time, they raised the cost of holding positions. They tried making it too expensive for participants to maintain exposure. Initially, it appeared successful. Price dipped, but then something unprecedented happened. The market absorbed the pressure. Why? Because the composition of market participants has fundamentally transformed. In 2011, the market was dominated by weak hands, speculators using 20 times leverage who couldn't handle margin calls. When the call came, they had to liquidate. Today's market is dominated by strong hands, industrial users, family offices, and sovereign wealth funds. These entities aren't speculating. They're hedging supply chains. They're preserving purchasing power. They have deep capital reserves. When the exchange demanded additional capital, these buyers didn't liquidate. They simply wired the funds. This is a catastrophic signal for suppression attempts. It means their pain threshold calculation was completely wrong. They assumed a 50% margin increase would break the rally. Instead, it barely registered. When a market ignores negative news or regulatory pressure, it signals extreme underlying strength. It means buyers aren't price sensitive, they're volume sensitive. They care more about securing physical metal than the margin requirement level. The failure of the margin increase to sustain any meaningful decline is the all-clear signal for the next leg higher. The banks have fired their best shot, and now they're standing there with an empty chamber facing a charging bull. Let's discuss what this does to market psychology. Markets operate on two primary emotions, greed and fear, but there's a third, more powerful force, regret. The V-shaped recovery, where price drops sharply then immediately recovers to new highs, is a regret-generating machine. Think about the participant who sold Friday evening. They were scared. They saw red numbers flashing. They thought they were making the smart move. I'll sell now and buy back cheaper at 55. They reasoned. They went to bed feeling secure. Then Monday morning arrived. Silver's trading higher than where they sold. They didn't save money. They lost their position entirely. Now they face a choice: admit the mistake and buy back at a higher price, or wait and hope for another decline. Most people wait. They refuse to buy back higher. They watch price climb to $65, $68, $70. The regret transforms into FOMO, fear of missing out. Eventually, they panic and buy back near the top. This is how explosive moves develop. The shakeout removes weak believers early. It makes the move lighter so it can accelerate faster. And it forces skeptics to chase price aggressively. This recent volatility was a cleansing event. It washed out leverage. It reset sentiment. It transformed overbought conditions into neutral conditions without actually breaking the uptrend. Technically speaking, it was a masterpiece of market structure. Whether this was engineered by institutions or just natural volatility, the result is identical. The path of least resistance is now pointing higher. But who actually bought this dip? It wasn't retail investors. Retail was scared. The volume data tells a completely different story. The buying originated in Asia, but it accelerated dramatically in London. This is the critical piece of the puzzle. For years, London has been the supply source. They've been the seller of last resort. But this morning, something fundamental changed. London switched sides. We're going to investigate this London pivot. We're going to examine why the bullion banks in the UK, who traditionally suppress price, are suddenly panic buying physical metal. We're going to explore reports that the available float has hit zero. And we're going to explain why this shift in institutional behavior virtually guarantees that previous highs will be exceeded. The trap was just the setup. The London pivot is the fuel. If you're just joining us, let's recap the timeline. Friday was the suppression attempt. Sunday night delivered the gap up. But the real story, the story that will define the next 6 months of this bull market, happened just hours ago in London. For 40 years, London has been the suppression capital of precious metals. The London Bullion Market Association is where major banks trade. It's where the fix is established. Historically, when price climbed too high, London would flood the market with supply. They were the reliable seller whenever needed. Whenever New York panic bought, London would calmly sell and cool things down. But today, London didn't sell, London panic bought. When UK markets opened, we witnessed massive, aggressive bid orders hitting the tape. This is a complete character change for this market. It's like watching a firefighter suddenly pour gasoline on flames instead of water. Why did they switch sides? Why are bullion banks suddenly chasing price higher instead of suppressing it? It's not because they became precious metals enthusiasts. Banks don't have ideology, they have liabilities. They switch sides because of one terrifying metric the public rarely sees: the float. We discuss inventory constantly, but inventory and float are not the same thing. Inventory is metal sitting in vaults. Float is metal available for sale. We're going to expose the collapse of the silver float. I'm going to explain the leasing mechanism banks use for price suppression and why that system just broke. And I'm going to show you why the seller of last resort has become the buyer of first resort. The trap caught retail shorts, but the float collapse just trapped the banks themselves. Let's clarify a critical misconception. Bearish analysts love pointing to LBMA vault data saying, look, there are still 800 million ounces in London vaults. There's no shortage. They're technically correct about the number. But they're completely wrong about the implications. That 800 million ounces is like an iceberg. The vast majority of that metal, probably 85 to 90%, is already claimed. It's owned by ETFs. It's held by sovereign wealth funds. It's owned by family offices who vaulted it in 2010 and haven't touched it since. That metal isn't for sale. It's strategic inventory. It sits collecting dust. It didn't move at $30 and won't move at $60. The only metal that actually impacts price is the float, the unallocated metal sitting in dealer accounts. Metal that can be leased to refineries, sold to tech companies, or delivered to commodities exchanges. Historically, this float was massive, hundreds of millions of ounces. But over the last 3 years, as major buyers acquired thousands of tons here and there, they didn't purchase ETF holdings. They drained the dealer pool. They emptied the float. So today, when we examine London, the iceberg remains. But the tip, the float, has vanished. It's melted away. This creates a liquidity crisis. If a major tech company needs 1 million ounces today, they can't access the ETF metal. They need to buy from the float. But the float is empty. So price must rise high enough to convince strong holders to sell. That price isn't $60. It probably isn't $100. We're in a situation where available supply is effectively zero, even though total supply appears healthy on spreadsheets. This is why London panicked today. The banks looked in the dealer pool to source suppression metal and found it empty. To understand why banks are buying, you need to understand the leasing market. This is the dark heart of the silver trade. Bullion banks don't just hold silver passively, they lease it out. They lend silver to industrial users like refineries or electronics manufacturers. The user takes the silver, utilizes it, and promises to return it later plus interest. This system allows industry to function without purchasing metal outright. It also allows banks to generate returns on their holdings. And crucially, it creates virtual supply. The same ounce can be leased, returned, and leased again multiple times. It creates the illusion of deep liquidity. But here's the problem: what happens when the industrial user consumes the silver? What if they manufacture it into solar panels or electronics? They can't return the physical metal. They must enter the open market, purchase replacement bars, and deliver those to the bank to close the lease. For years this was simple. Silver was cheap and available. But now refineries face constraints. The float has vanished. Industrial users are calling banks saying, "We can't return the metal. We can't source any to purchase." This causes silver lease rates to spike. When lease rates spike, the market is screaming shortage. It means banks are desperate to recover their physical metal. Today, we're seeing clear signs the leasing mechanism has jammed. Banks are realizing the metal they leased out is never returning. It's gone permanently. It's installed on rooftops in Germany. It's inside electric vehicles in California. So banks have a hole in their balance sheets. They show silver as an asset on their books, but the vault is empty. To fix this, they must enter the spot market and purchase physical bars to replace the consumed ones. This is the London pivot. Banks aren't speculating on price appreciation. They're frantically trying to fill the hole in their vault before regulators discover it. They're physically covering short positions. This buying is completely price insensitive. They don't care if it's 63 or 65. They need the metal to balance their books. This is the most explosive type of buying pressure imaginable. There's a final layer to the London situation: unallocated accounts. Many wealthy investors and institutions hold silver in unallocated accounts in London. This means you don't own specific bars. You own a claim on a pool of silver held by the bank. It's similar to depositing cash. You don't own specific bills, you own a claim on the bank's liquidity. For decades, banks operated a fractional reserve silver system. They might hold 100 ounces of physical silver for every 500 ounces of claims they sold. They assumed not everyone would request their metal simultaneously. But recent events, major industrial announcements, and Friday's volatility scared large capital. Family offices are now saying, "I don't trust unallocated accounts anymore. I want to convert to allocated. I want specific bars with serial numbers. I want them moved to private vaults." This is effectively a bank run on silver. When a client converts from unallocated to allocated, the bank must remove specific ounces from the general pool and assign ownership. That silver is now removed from the float permanently. If the bank was running fractional reserves, holding only 20% real metal, and 30% of clients demand allocation, the bank becomes insolvent. They must rush to market and purchase the missing bars. This is exactly what fueled this morning's rally. It's a silent bank run. It's not people lining up at coin shops. It's billionaires sending legal notices to bullion banks demanding physical segregation of assets. And banks are buying aggressively to fulfill these demands. They attempted to suppress price Friday to discourage these conversions. It failed. Demand for allocation actually increased over the weekend. So now banks are forced buyers at any price. So we have the trap set up. We have the London pivot and the leasing crisis. The stage is set. We're currently trading around 63.35. Directly overhead sits the psychological barrier of $65. If we break 65, the chart opens up dramatically. There's virtually no resistance until all-time highs. I'm going to show you the technical roadmap for this week. I'm going to explain why 65 is the line in the sand for short sellers. And I'm going to tell you exactly what to expect when U.S. markets open in a few hours. Will American investors join the buying surge, or will there be one final intervention attempt? The float has vanished. Banks are trapped. The squeeze is active. We're trading around 63.35. We've recovered Friday's losses completely. But 65 is different. 65 isn't just a resistance level, it's the termination point for short sellers. Why is 65 so critical? Is it arbitrary? No, it's pure liability. In the derivatives market, speculators purchase call options, bets that price will rise. Right now there's massive open interest concentration at the $65 strike price for December and January contracts. Millions of ounces are positioned betting on a break above 65. Here's the problem for banks who sold those options: if silver stays below 65, those options expire worthless. Banks keep the premium and win. But if silver crosses 65, banks are obligated to deliver millions of ounces at a discount. This creates a phenomenon called delta hedging. As price approaches 65, market makers get nervous. Their algorithms force them to buy silver futures to hedge exposure. If they sold a call option on 5,000 ounces, they might need to purchase 2,000 ounces of futures for safety. But here's the critical dynamic: their buying pushes price higher, which increases their nervousness. So they must buy more futures, which pushes price even higher. This is called a gamma squeeze. It's a self-reinforcing feedback loop. It's what happened with certain stocks in recent years, and it's waiting to happen here. If we break 65 with strong volume, market makers flip from neutral to forced buyers. They'll have to chase price to 66, 67, 68 just to cover exposure. This is the vacuum effect. Above 65, resistance disappears because defenders become buyers. This is why you'll see massive volatility around 64.80 or 64.90. Banks will deploy everything they have at that level to prevent the breakthrough. They'll sell paper aggressively. They'll trigger stops. But if physical demand from London and Asia continues pushing, the barrier will break. We're approaching US market open. This is the moment of truth. Usually the US Open is where rallies face their toughest test. For years, we've seen the pattern Asia buys, London buys, then New York opens and suppresses price. It's almost clockwork, the 10 a.m. reversal. But today feels fundamentally different. Why? Because American investors are waking up to the same news that panicked London. They're reading about major industrial developments. They're seeing export restriction rumors from Asia. And crucially, they're seeing green charts. American investors are momentum casters. When they see silver up 160 overnight, they don't think it's expensive, they think they're missing out. FOMO is incredibly powerful. We're likely to see a wave of retail buying hit ETFs at the open. This cash inflow forces ETFs to purchase metal to match demand. This adds another layer of buying pressure on top of the London bid. However, there's an adversary, the dollar index. The Federal Reserve and Treasury watch silver price closely. Runaway silver signals runaway inflation concerns. It makes the dollar appear weak. Often during U.S. sessions, you'll see sudden dollar strength attempts to cool commodities. So the battle at US Open will be FOMO crowd versus dollar defense. If price holds steady through the morning session without massive reversal, shorts are in serious trouble. It means dollar defense failed. It means U.S. investors have joined the global momentum. Watch volume carefully. If volume is high and price rising, the rally is authentic. If price rises on low volume, exercise caution. It could be a trap. But given Friday's setup, odds favor continued strength. There's one more signal to monitor today: mining stocks. Friday, when silver dropped, miners got hammered. Major names dropped 4 to 5%. Investors treated them like disaster was imminent. But today, silver's recovered completely. Mathematically, miners should gap up massively at the open. If silver's at 63.35, these companies are generating significant cash flow. However, miners often lag physical metal at turning points. Wall Street moves slowly. They wait for confirmation. They want assurance the rally isn't temporary. This creates a temporary opportunity for astute investors. If silver maintains these gains, mining stocks must catch up. It's basic mathematics. The disconnect between metal price and stock price is stretched significantly. When U.S. markets open, watch junior silver miner ETFs. If silver's up 3%, these should be up 6 or 7%. If they're only up 2%, that represents opportunity. It means stocks are undervalued relative to the commodity they produce. This disconnect happens because equity traders are cautious. They remember Friday clearly. But commodity traders understand the shortage is real. Eventually, equity traders will panic buy miners. The catch-up trade can be explosive, so we have the complete setup. We have the 65 gamma wall. We have the US FOMO wave potential. We have the mining stock catch-up opportunity. The next 24 hours will be volatile. You'll see spikes. You'll see dips. But you cannot lose sight of the bigger picture. Whether silver closes today at 63 or 64 or 66 is noise for long-term investors. Because the forces driving this move: major industrial demand, strategic buying from sovereign entities, empty vaults. These aren't day trading forces. These are structural forces. They don't disappear at closing bells. I'm going to zoom out completely. I'm going to provide the year and target based on this new momentum. And I'm going to leave you with the final psychological preparation you need to navigate the volatility of the coming weeks. The trap has snapped shut. The rocket has cleared the tower. Now we just need to maintain conviction. We've reached the conclusion of this market alert. We've analyzed the failed trap from Friday. We've exposed the London pivot where banks transformed from sellers to buyers. We've examined the gamma wall at 65 that's currently under pressure. But now I want to zoom out completely. It's easy to get lost in minute-by-minute price action. It's easy to obsess over whether silver's up 2 or 3% today. But the most important signal isn't the percentage gain, it's the structure. The market just communicated something profound. It established that 61.50 is the floor. Think about the implications. A few years ago, $30 was the ceiling. Now 61.50 is the price level where billionaires rush to buy aggressively. The entire valuation framework for silver has shifted fundamentally. As we head toward year 2025, we're entering a specific seasonal window that favors strength window dressing. I'm going to explain why hedge funds who avoided silver for a decade are about to become unexpected allies. I'm going to explain the pain trade theory. And I'm going to leave you with the final strategy for navigating the remainder of December. The trap didn't just snap shut, it locked the door on low prices permanently. We're in mid-December. This is critical timing for Wall Street. It's fiscal year end. Hedge funds and mutual funds must send annual reports to clients. These reports list portfolio holdings. Here's fund manager psychology: if silver is the top performing asset of the year, driven by technology and supply constraints, and the fund holds zero exposure, they look incompetent. Clients will ask, why didn't we own the best performing asset? Career risk becomes real. So what do in the final 2 weeks of December? They window dress. They purchase winners at any price just to show it on balance sheets December 31st. They want to claim, look, we own silver. We participated in the rally. This creates artificial but powerful momentum into year-end. Funds that ignored silver at $30, $40, and $50 are now forced to buy at $63 just to save reputation. They're price insensitive, they just need the position. This institutional FOMO is what drives parabolic moves in late December. We've seen it with technology stocks historically. Now we're seeing it with commodities. Recent industrial news gave them the narrative cover. Price action provides the urgency. So if you see silver rallying even on moderate volume during holidays, don't be surprised. It's institutional money trying to appear smart after being wrong all year. And you who bought at 25 or 30, you're now in position while they chase. Or better yet, you're not selling at all. Markets are designed to transfer wealth from the many to the few. They typically move in the direction of maximum pain. Right now, ask yourself, what outcome causes the most collective pain? Scenario A, silver crashes back to 50. Who suffers? Silver believers. But long-term holders are accustomed to volatility. We've held through decades of suppression. We don't panic, sell on dips, we accumulate more. So a crash doesn't generate liquidity, it just locks supply tighter. Scenario B, silver surges to 75. Who suffers? Number 1, banks who are short hundreds of millions of ounces. Number 2, industry desperately needing silver for solar and batteries. Number 3, the public holding cash watching inflation erode purchasing power. Number 4, professional investors underweight commodities. Scenario B causes maximum pain to establishment players. It damages bank balance sheets. It forces industrial panic. It humiliates professionals. Therefore, according to market dynamics, Scenario B becomes the higher probability outcome. The market wants to squeeze shorts. The market wants to force uninvested capital to chase highs desperately. Friday's trap was the final attempt to shake you off before the move accelerated. If you're still holding, you've aligned with the pain trade. You're now inflicting the pain, not receiving it. Let's end with the macro perspective. Why does this 160 move matter so significantly? Because it confirms the wealth transfer. For 40 years, wealth flowed from physical to financial, from factories to derivatives, from gold to government bonds, from silver to technology stocks. That tide is reversed. Major industrial developments aren't just gadgets, they're proof the physical world is reclaiming value. You cannot print a battery, you cannot print solar panels, you must extract it from the earth. When silver price gaps up while bond markets wobble, the market is voting for reality. The market is declaring that an ounce of silver, which requires labor, energy, and geology to produce, is worth infinitely more than digital entries on central bank computers. You're living through a historic pivot point. Future generations will ask what you did during the resource crisis of the 2020s. Did you hold paper or physical assets? Friday was a test of conviction in that thesis. If you held, you passed. Monday is vindication. The day the trap failed, the day London panicked, the day the path to 65 opened up. I want to leave you with one final warning. Just because momentum is favorable doesn't mean volatility is finished. The swings will intensify. $2 moves will become $5 moves. $5 moves will become $10 moves. You need mental preparation. If you're over-leveraged, you'll get washed out. If you're watching tickers constantly, you'll get stressed. The strategy remains straightforward: accumulate physical assets, secure quality mining exposure, and maintain conviction. The market is doing the work for us. The shortage is doing the work for us. Industrial demand and strategic buying are doing the work for us. Let institutional money chase price. We're already positioned. Congratulations to everyone who maintained conviction. Enjoy this phase of the move. Subscribe for continued updates. The content in this video is for educational purposes only and represents personal opinions and market analysis. It should not be considered professional financial or investment advice. Financial markets, including silver and precious metals, are volatile and subject to significant risks. The scenario described involves a mix of historical fact, current market mechanics, and analysis based on present trends. You should always conduct your own due diligence and consult with a certified financial planner or advisor before making any investment decisions. I am not responsible for any financial losses or decisions made based on the information provided in this video.